This is the chart that proves that during the next financial crisis, the Federal Reserve will have to print the currency into oblivion. I'll get back to this chart later, and I'll explain it later in the video, but it is one of the scariest charts out there. But first, what happened today? The Fed cut the rates, the Fed funds rate, by 0.5 point to combat the coronavirus crisis. So that's what I'm calling it now. It's the coronavirus crisis. And now just 3 weeks ago, the Fed was pretty much jawboning, guaranteeing, they were saying there won't be any rate cuts this year, that's it. And it wasn't just the chairperson, Jerome Powell, but other people at the Fed were also saying no more rate cuts in 2020. And here, 3 weeks later, we've got rate cuts. But there's sort of a battle brewing over this because Trump is demanding more easing and cutting right after the Fed slashed its rates. But the Fed is now, they're impotent. They are not able to control things anymore. They are losing control. Right after they cut rates, the markets went up, but then Treasury yields collapsed and the Dow lost from its peak today to its trough. It lost 1,400 points. It recovered some of that. And so here's a look at what happened today in the Fed. This is a 5-day chart, and it's also a 5-minute chart. So this is a day, and this is a day, and then each data point is 5 minutes on this chart. And so what you see here is that, we had the crash that's been happening over the past couple of days last week, and it stabilized. And then on Monday, the markets rebounded a bit. And then today, when they opened, they started to fall, and then the Fed made their announcement of the rate cuts. And the markets said, party time! And the markets went way up, but then they said, uh-oh, they're cutting rates. It must mean that something's wrong. And so we had this big sell-off. And that is probably, something like that is going to continue over the next couple of weeks or months. I expect it to get a lot worse. 10-year Treasury yields falls below 1% for the first time after the Fed slashes rates. So here's the 10-year Treasury, and you see it ended the day at 1.1% yield. So you're loaning the government your currency for 10 years during a period of time where they're trapped in a corner and they have to devalue the currency. They have to print the currency into oblivion, basically. And you're loaning them this for 10 years, and you're getting paid 1.1% annually. Here's the 30-year Treasury at 1.66%. This spot in the middle is where Alan Greenspan, during his tenure at the Fed, the Treasury stopped issuing the 30-year bond. But the rest of it, it's just this, it's a bull market in bonds when yields are falling. So this is getting close to the end of a debt supercycle here. This is one of the longest bull markets in history. It's going to reverse sometime or another. Not at first, though. We're in for lower interest rates in the future, the near future, and we're in for a short-term deflation. I'll show you some of the reasons why. So you've seen me follow the dynamic yield curve before, where you can grab this thing and you see what the yield is on the 3-month Treasury bill, the 2-year, the 5-year note, the 10-year note. One of the important things that the Fed is trying to do is to keep the 2-year from rising above the 10-year, or the 10-year from falling below the 2-year. And so that's always been a predictor of recession when it does that, and stock market crashes. You can see an inverted yield curve here where the 2-year is higher than the 10. And then we had a big stock market crash with the popping of the tech bubble. And then we've got these are called positive curves when it has that slope where it starts off low and goes up to high. And then it inverts again. And then shortly thereafter, the global financial crisis of 2008. But what I find interesting is that, if you look at this here last year, June, July, when we get to October, there was a rate cut, right? right in there. There was a rate cut in October of last year. So it went down from 2.25% down to 2%. But then in just the past couple of weeks, there have been more cuts of the 3-month bond. And this is as of the 2nd of March, so it's as of yesterday. This is before they announced the rate cuts. And so the rate cuts in the Fed funds rate are just to sort of put it into alignment on what the Federal Reserve has already done to the short-term U.S. debt, the 3-month Treasury. You can see here now, this chart goes back to February 11th, and so each one of these is a week. And what you see here is the Fed accomplishes this through temporary open market operations. So this is in the repurchase agreements markets. But they intervene in these markets and start doing these repurchase agreements. And the rates dropped on the 27th of February, the 28th of February, the 2nd of March. They had already gone from this 0.5% rate cut had already taken place in the bond market from 1.525 roughly down to 1.13. So that 0.5% that they just announced today put the Fed funds rate in alignment with what had already taken place in the markets. It's sort of yesterday's news. This is Investors Business Daily, projecting that negative U.S. yields are in sight as virus spurs recession bets. And then Dan Tapiero writes that rates are going to zero. 10 years, this is the 10-year Treasury he's talking about, could be 50 basis points or less. So that's 0.5% or less for loaning the government your currency for 10 years. For an institutional portfolio with a mix of equity and government bonds, your bonds will no longer act as a stabilizer/hedge and are limited in price appreciation by the zero bound. That's the zero bound is when bonds go to zero. They can't go too much further than zero. They can go negative a little bit. But at zero, it becomes more profitable for you to go to the bank and withdraw cash and just hold cash. Anyway, gold is the only liquid hedge with no price cap. Now, this is a picture of the market crash that the Dow Jones Industrial is going through at the moment. So this is the past few weeks here. And but I like to take a long-term view of things. So here you've got like a 25-year chart or whatever it is. I think it's 25 years. And you can see that it really isn't that bad yet. It's going to get worse, a lot worse, and we're coming to that and the reasons in a moment. But you can see other drops. The crisis of '08 here was a really big drop, and look at how far this dropped right there in a very short period of time. But in taking the really long view, here's 100 years of the Dow. And this is a logarithmic chart. So you can see that the change from 125 to 250 is 100%, from 250 to 500 is 100%, from 500 to 1,000 is 100%, from 1,000 to 2, even though this is, a 125-point change, a 250-point change, 500-point change, 1,000-point change, each space is a 100% change. And what you see here is it puts things in real perspective. What we're going through here is nothing compared to the 2008 financial crisis, which was nothing compared to the 1929 stock market crash to 1932. The Dow was a breath away from 400 points in its peak in 1929, and it crashed all the way down to 42 points. So it was just horrendous. And I think it's absolutely possible that something like that could be coming at us again. And here is the reason. Is fiscal stimulus the answer to preventing a coronavirus recession? Well, this isn't going to be a recession. This isn't going to be some mild recession. This is going to be a full-blown depression, I believe. Now, you've got to understand the difference between fiscal stimulus and monetary stimulus. Monetary policy is what the Federal Reserve does. They either manipulate interest rates or they create currency. That's monetary policy. Fiscal policy and fiscal stimulus is what the government does. A bunch of politicians all get together and decide, well, we're going to cut taxes and we're going to increase deficit spending. So to get out of the problems that were caused by taking on too much debt, we're going to spend ourselves a whole lot deeper into the hole. So that's the difference between fiscal stimulus and monetary stimulus. But coronavirus could infect 2/3 of the globe, and that is from an advisor to the World Health Organization. And if you look at past pandemics and then the way that this virus is spreading, this is a fairly, somewhere between a quarter of the world's population and 3/4 of the world's population is probably going to end up with this virus. Then you go on to the World Health Organization just revised their death rate up from 2.7 to 3.4% globally. Now, let me take a little detour here. I'm going to take 7.7 billion people, so 100,000 million billion, 7.7 billion people, times 2/3, 0.66. And you end up with about 5 billion people that could catch this thing, times a death rate of 3.4%. That's 172 million people that could die. This disease will kill millions. I have no idea. This is everybody right now is just speculating. And I'm just running a mathematic exercise here based on what the World Health Organization says and what some of their advisors are saying. And so that is going to lead to some, right now, the Federal Reserve is out of ammunition. The last crisis that we had, the global financial crisis in 2008, we were up at 5.25%, and they had to slash rates by more than 5% to and create $3.2 trillion worth of currency. They injected $3 trillion directly into the markets through quantitative easing. And then we got up to 2.4%. We just cut this down to 1%. So we're down here somewhere now. So there is no more ammunition when it comes to cutting rates. And so all the Federal Reserve can do is create currency. And a couple of ways that the Federal Reserve can do that is through something. A lot of people have been talking about repurchase agreements. These are overnight repurchase agreements here. And this is temporary market operations, open market operations. Now, what an overnight repurchase agreement is some institution, a bank, a fund, some institution needs to raise cash quickly. They have some cash need that's like an emergency. They need to raise it right now. They go into the repurchase markets, and the Federal Reserve will create a bunch of currency, and the fund or the entity pledges a bond or a bill or a note, a U.S. Treasury, to the Federal Reserve. The Federal Reserve creates that currency. They created $80 billion because of the September 11 terrorist attacks in one day. Now, these get rolled over day after day. So there's like average levels here, but you can see that the average levels used to be between 5 billion and 15 billion a day during this time period before QE. And then they just completely shut off repurchase agreements, and then they started them up again last September. But look at where we're at today. You've got the terrorist attacks at a little over 80 billion. You've got the Lehman Brothers global financial crisis at 100 billion, and here we are today at 100 billion. Something as bad as the global financial crisis of 2008 is what the Federal Reserve is seeing out there. And everybody's been talking about repurchase agreements, but nobody's been talking about regular open market operations, permanent open market operations, where the Federal Reserve has been buying short-term bills like the 3-month Treasury. And they started this back in August, but they started really accelerating it in October. So they saw something coming at us, and they've seen it for quite a while now. But what's interesting here is we're up at $2,474 billion at this point. And that's that's the highest it's ever been. It's higher when they finished QE here. This is when they stopped quantitative easing. So there's something big happening out there. We don't know what it is yet, but I think that they see what I see with coronavirus, and they're just not telling people about it. Now, one of the things that really worries me, you are going to be seeing the biggest bankruptcies in history, the most bailouts in history, and it's going to be at a frantic rate, and the Federal Reserve has to just create the currency to accomplish all of these bailouts. There will probably be bank bail-ins too, so you want to make sure you don't have too much currency in a bank, in any one bank account, or any combination of bank accounts at a single bank. This is non-financial corporate business debt, securities, and loans. So it's whatever corporate debt that corporations have taken on to do all of their stock buybacks and all of that stuff, divided by the gross domestic product, the size of our economy. And what you see is that you get into a trouble zone whenever it exceeds 40% of the economy. It got up to 43% of the economy back in 1990, and then we had the savings and loan scandals and the crisis there, and the economy got really bad, and 3 of Donald Trump's casinos went into bankruptcy in one of his hotels. And then we had the growth of the economy again, the tech bubble, and it got to 45% of GDP. And what happened then was we had the bankruptcies of WorldCom and Global Crossing, the largest bankruptcies and bailouts in history to that date, Enron and so on. And then we had the real estate bubble in 2007 and 8. And then this crisis happened, the 2008 global financial crisis, and we had Lehman Brothers, Chrysler, General Motors, just huge, the biggest bankruptcy. And Lehman Brothers was like 7 times the size of WorldCom and Global Crossing. This is the budget deficit or surplus. And what they're doing is, there's a zero line here. Deficits are below the zero line. Surpluses are above. This is a lie. They're telling us that they spent $984 billion more than their income last year. So in 2019, we went into the hole by spending $984 billion more than our income. And the reason I call this a lie, and I can prove it, is you generate a chart of the total federal debt, the public debt. I think it's interesting. Federal debt, total public debt. So this is the debt that you and I owe. It's not federal. It's us that owe this debt. But when you take that, you click Edit Graph and you change some of these things. I change it to millions of dollars of change annually. And when you do that, what you find is that we actually spent $1,336 billion. So we're already running greater than $1 trillion deficits right now, today. That is what is happening. Last year was a $1.336 trillion true deficit, not the hocus pocus magic smoke and mirrors accounting that they use to come up with these numbers. But we actually owe $1.336 trillion more this year than we owed last year. Oh, this is 2018. So in 2018, they said it was $779 billion. So you can see that the lie is huge. It's like, you take whatever they're saying and add 30 or 50% and you come up with the truth. So this is the true deficit. And by the way, there were never surpluses in the Clinton years. It didn't happen. It was an accounting trick. There was an $18 billion deficit. Now, this one's measuring the size of the public debt, so this graph is right side up. The other graph that we were looking at is inverted because they're putting these minus numbers of spending. So the debt to GDP is already up at 105%. And with this next crash, GDP is going to collapse and deficit spending will explode because of both monetary and fiscal policy. They're going to try to spend us out of this debt hole by cutting taxes, which Donald Trump has already proposed. He proposed a payroll tax cut today. I'll get into that in a different video because that sounds like it's going to benefit the person that's actually getting paid. But payroll taxes are the taxes. It's basically income tax, but it's paid on behalf of the employee by the employer. And between income tax and payroll taxes, it makes up almost 80% of the total federal government revenues. So they're talking about cutting a major portion of federal government revenue at a time when our GDP is shrinking. And that brings us back to this chart. This is something that I came across back in 2013 or 14. I was looking at the federal government current tax receipts, so the government's income, the current tax receipts. And I went, oh my God, that looks like the stock market. And so what I did was I overlaid the value of the stock market, the Wilshire 5000 full market cap index. And here what I've done is I've indexed them together at the beginning of this recession here. And you can see how they lay over the top of each other. But what you see is that I believe this was a 28% fall in the value of the stock market from the crash of the NASDAQ and so on, the tech bubble popping in 2000. And it caused a 20% reduction in taxes, which means deficits explode. And then we get up to the real estate bubble of 2008, and then the global financial crisis, and the markets crashed 40%. The value of the stock market fell by 40%, and tax revenues fell by 28%. So this was 20% less taxes, this was 28%. Well, what we've seen here is tax revenues stopped growing at the end of QE. The tax revenues started. What's interesting is QE 1 and 2 sort of trickled down into from Wall Street to Main Street, but QE 3 was just a gift to Wall Street. But the stock market still went on this crazy binge, and now we've got a long way to fall, but you're going to see the greatest contraction of tax revenues during a period of time where they're going to be creating immense amounts of currency. So get ready for multi-trillion-dollar deficits every year. $2, $3, $4, $5 trillion deficits. They are coming. Which brings me to on the weekend here, last weekend, I bought some silver. And I just want to point out, this is a chart from when gold bottomed in 1999, gold's performance and silver's performance and the stock market's performance. So this is the S&P 500, which is now down at 123% gains from 1999, and that's not inflation adjusted. If you inflation adjust that, it's way down here somewhere. Gold hit 550%. It's still up. It's up 508% since 1999. Best performing assets of this century, with the exclusion of a couple of cryptocurrencies. Some cryptocurrencies have done much better. But what I'm very concerned about isn't that, it's this number right here, the gold-silver ratio. It's only been this out of whack just a few times. There was one, about a year or so back in the 30s, and then just a couple of months here in 1991. And so silver is tremendously undervalued. Gold is tremendously undervalued compared to the currency supply and all of the other assets that are in bubbles. And so that's the reason I bought silver last weekend. And this is interesting. So this is the price of silver going back to 1970. And what you see here is that this looks like it exceeded its previous peak. It didn't. I don't know what's wrong with this, but this was actually $50. This was $48. But if you take it and divide it by the Consumer Price Index, which I call the CPI because it vastly understates inflation. But because every dollar that they create has to go somewhere, period. There's no discussion about that. Every dollar created goes somewhere. So something inflates. This selective inflation all depends on where the dollars go first. And they've gone into the stock market and back into real estate and things like that. So that what they measure, though, they don't measure those things. The stock market isn't in the CPI. If they took everything in society and put it in the CPI, what you would see is that silver's true price adjusted for inflation would be somewhere way down here, way, way, way below the 1980 high. So anyway, that's the reason I bought silver. Get prepared for something big. They're going to be to keep the stock markets up. That chart that I showed you, this chart, in order for the government to survive, when I created this back in 2014, and I put it in the revised version of the updated version of my book in 2015, I called this the financialization of government. What you see here is very little correlation before this century. But since this century, our government has become highly financialized, and the very survival of the government depends on the stock markets doing well. And so that means as the stock markets crash, the Federal Reserve has to support them. And they have to, Janet Yellen just a couple of weeks ago said that in the next crisis, the Federal Reserve may have to go into the stock markets and buy stocks directly. So that means just creating currency and buying stocks. And so this will crash, and then it'll turn around and go up. And when it's crashing, we're going to have deflation. Gold and silver may go down. I'm hoping they do. I'm going to be using every pullback. I'm hoping for $14 silver or less. And I'm going to keep on buying. And there's going to come a day when that reverses, and when it does, it's going to explode to the upside, and it's going to be an explosion the likes of which the world has never seen. Thank you very much for listening. We'll see you next time. At goldsilver.com, we have a price match guarantee, free shipping, and global storage options. Thanks for making goldsilver.com your bullion dealer.